The Fed and the dollar, when central banks became the quiet kings. New York, 1907. Wall Street is not the canyon of glass you know today. It is stone, iron, and smoke. Men in hats, paper fluttering like snow, horse-drawn wagons hauling coin and documents. And right now, it is panicking. A run on the Knickerbocker Trust Company has spilled into the streets. Depositors line up, desperate to pull their money before the bank shuts its doors. Rumors jump from firm to firm like sparks in a dry forest. There is no Federal Reserve. There is no government backstop. There is, at this moment, one person everyone is looking to. Not a president, not a treasury secretary, a banker, J.P. Morgan. He gathers other financiers into his library, locks them in, and refuses to let them leave until they commit enough money to stop the bleeding. For a while, one man's balance sheet and reputation stand between the system and collapse. It works, this time. But when the dust settles, the question is obvious. What happens when the next crisis hits and there is no JP Morgan, or he fails? The United States had tried central banking before. Twice, in fact. The first bank of the United States in the 1790s. The second bank of the United States in the early 1800s. Both became political lightning rods. Arguments about whether they were constitutional, whether they concentrated too much power, whether they favored the commercial elite over farmers and frontiersmen. Andrew Jackson famously killed the second bank in the 1830s, leaving the country with a patchwork of state banks, wildcat banks, and occasional panics. By the early 20th century, the country is industrializing fast, railroads and factories everywhere, but its financial plumbing is still rickety. The panic of 1907 makes the vulnerability impossible to ignore. A group of senators, bankers, and economists start to talk seriously about a new kind of institution. Not a single private bank, not a fully government-run office, something in between. In 1910, a small group of men board a train in New Jersey, pretending to be a duck hunting party. They are not carrying shotguns. They are carrying draft legislation. The destination is Jekyll Island, a private retreat off the coast of Georgia. There, in a clubhouse surrounded by marsh and oak trees, they spend days hammering out the blueprint of what will become the Federal Reserve System. They want an institution that can lend to banks in a crisis, smooth out seasonal swings in money demand, provide a flexible currency, not just fixed piles of gold. But they are operating in a politically hostile environment. Americans still remember the central bank battles. Populists distrust Wall Street. Farmers feel exploited by Eastern capital. So they design something deliberately weird. A central bank that is both public and private. A system, not a single building. In 1913, after a long fight, the Federal Reserve Act passes. The new system has three key parts. At the top, a board in Washington, appointed by the President and confirmed by the Senate to represent the public interest. Around the country, 12 regional Federal Reserve banks, each with its own board that includes private bankers and local representatives. And a new currency, Federal Reserve Notes, which will eventually become the paper dollars in your wallet. Banks that join the system hold reserves at their regional Fed. In a panic, they can borrow from the Fed to meet withdrawals instead of going straight to the edge and hoping JP Morgan is in a good mood. The Fed can also influence short-term interest rates by changing the rate at which it lends to banks and by buying or selling government securities in the open market. In theory, this combination should make the financial system more stable. In practice, the Fed spends its first decades learning, painfully, how much damage a central bank can do by action or inaction. In the 1920s, the Fed is still young, its role fuzzy. It tries to lean against speculation at times, raises interest rates, then eases. It is one player among many in a market still dominated by private banks and gold flows. Then comes 1929. The stock market crash is spectacular, but the true catastrophe unfolds over the next few years. Banks fail in waves. Depositors lose their savings, prices fall, factories idle, unemployment climbs. The Fed, worried about gold reserves and moral hazards, does not fully act as lender of last resort. It lets many banks go under. It allows the money supply to contract. It does not push hard enough, early enough, to keep the system liquid. Some of its own leaders later admit this was a failure. If you think of the financial system as a heart and blood vessels, the Fed allowed a kind of cardiac arrest. From this tragedy, several lessons are carved into policy. The Fed must be ready to flood the system with liquidity in a crisis. It must watch not just interest rates, but bank health and money supply. It must coordinate with fiscal authorities during severe downturns. These lessons will echo decades later. While the Fed is learning its mandala of rates and reserves, the dollar is undergoing its own transformation. In 1944, as World War II is still raging, representatives from dozens of countries gather in Bretton Woods, New Hampshire, to design a new international monetary system. The United States emerges from the war with the world's strongest economy and most of the world's gold. The agreement that takes shape is simple in outline. Other countries peg their currencies to the dollar. The dollar itself is pegged to the gold at a fixed rate. Central banks hold dollars and gold as reserves. The Fed, indirectly, becomes not just America's central bank, but the anchor of the global system. If another central bank needs dollars to defend its currency peg, it can borrow them. If it has surplus dollars, it can hold them in US Treasury bills and bonds, which pay interest and are considered safe. The dollar moves from being merely a national currency to something else. The grease in the gears of world trade. Over time, so-called Eurodollar markets emerge, where banks outside the United States hold and lend dollars without directly going through the Fed. Oil contracts and commodities are priced in dollars. Sovereign debt are often issued in dollars. The Federal Reserve does not control every place where the dollar flows, but its decisions ripple into all of them. The Bretton Woods system has a built-in tension. As global trade expands, the demand for dollar increases, but gold supplies are finite. If foreign central banks ever lose confidence in the dollar's value and start demanding gold in exchange for their piles of dollars, the United States could run out. In 1971, facing pressure on gold reserves and domestic economic issues, President Nixon announces that the United States will no longer redeem dollars for gold at a fixed rate. The dollar is no longer convertible into gold. It floats. So do other major currencies. Some worry this will unleash chaos. Instead, after a period of volatility and adjustment, the dollar remains at the center of the system for a pragmatic reason. There is simply no other asset as deep and liquid as US Treasury securities. The world keeps its savings and its rainy day funds in instruments tied to the dollar. The Fed, therefore, keeps a strange dual identity. It must answer the Congress and the American public, but its actions are watched and felt by central banks, corporations, and households far beyond US borders. Unlike many earlier central banks, the Fed eventually gets a formal dual mandate written into law: promote stable prices and maximum employment. In plain language, try to keep inflation under control without crashing the job market. It does this with a handful of main tools. It sets a target for the interest rate at which banks lend reserves to each other overnight. Raise that rate and borrowing costs go up across the economy. Lower it and money becomes cheaper. It conducts open market operations, buying or selling government securities to add or drain reserves from the banking system. It can lend to banks directly in times of stress through its discount window. In extraordinary times, it can also buy longer-term assets like longer-dated government bonds and mortgage-backed securities in what is called quantitative easing to push down long-term interest rates and support credit markets. If all of this sounds abstract, that is kind of the point. The Fed operates through signals and incentives, not through direct commands to specific businesses or households. It changes the weather. Everyone else decides whether to bring an umbrella. In the 1970s, the United States experiences a painful combination: high inflation and high unemployment. Oil shocks, wage price spirals, and policy missteps all play a role. By 1979, inflation is a political and economic emergency. Paul Volcker, the new Fed chairman, decides the central bank must prove it is willing to do whatever it takes. Under his leadership, the Fed drives interest rates up, not just a little, into the teens. Borrowing becomes brutally expensive. Mortgages, business loans, everything. The result is a sharp recession. Factories close, unemployment rises, but inflation eventually breaks. Volcker's move is controversial, harsh, and, in the eyes of many economists, necessary. It reinforces an idea that will define central banking for decades: credibility. If people believe the central bank will fight inflation aggressively, they are less likely to demand big wage and price increases preemptively. Expectations matter as much as actual rates. From then on, the Fed becomes as much a manager of beliefs as of balances. Fast forward to 2008. The housing market cracks. Mortgage-backed securities tumble. A global web of derivatives transmits losses in ways few fully anticipated. Lehman Brothers fails. Money market funds, usually seen as ultra-safe, break the buck. Commercial paper markets freeze. It is the modern equivalent of a heart attack, not in a national economy, but in the global financial body. This time, the Fed does not sit back. With Ben Bernanke as chair, a scholar of the Great Depression, it opens emergency lending facilities not just for banks, but for money market funds, primary dealers, and, through certain programs, for specific segments of credit markets. It slashes interest rates to near zero. It buys massive quantities of government bonds and mortgage-backed securities, expanding its balance sheet in ways previously unthinkable. Other central banks coordinate similar actions. Swap lines are opened so foreign central banks can access dollars and lend them to their own institutions. Critics cry moral hazard, say that rescuing markets encourages reckless behaviors. Supporters argue that without such actions, the financial system would have imploded, dragging the real economy into a depression. The response is not perfect, but it is decisive. The Fed has become, undeniably, the lender of last resort in practice, not just on paper. In 2020, a different kind of crisis hits. Not a financial bubble, but a virus. Lockdowns and fear cause economic activity to seize up. Entire sectors shut overnight. Markets convulse. For a few terrifying days in March, even US Treasury markets, usually the deepest and safest in the world, wobble. Again, the Fed moves fast. It cuts interest rates back to zero. It launches enormous asset purchase programs. It sets up special facilities, some in coordination with the Treasury, to support corporate bonds, municipal bonds, small business lending. At the same time, fiscal authorities pass huge relief packages. The line between monetary policy and fiscal policy blurs. Once more, the question follows, how far should the central bank go? Is it just supposed to nudge interest rates, or has it become effectively a giant shock absorber for every kind of stress? The Fed emerges from the COVID crisis with an even larger balance sheet, and with inflationary pressures building again. It begins the delicate task of rising rates and withdrawing support without causing a crash. Running a central bank starts to look less like steering a ship and more like surfing on a wave of forces you do not fully control. Throughout all of this, the dollar is both tool and symbol. Countries borrow in dollars. Commodity contracts are written in dollars. Corporations with no American operations still issue dollar bonds because global investors crave them. When storms hit, people around the world rush into dollar-denominated assets, driving the currency up. When times are calmer, they search for yield elsewhere. The Fed sets policy primarily with US employment and inflation in mind, but every decision radiates outward. A rate hike in Washington can tighten financial conditions in Sao Paulo, Lagos, Jakarta. A dovish pivot can send money flooding into emerging markets, then racing back out when sentiment changes. In that sense, the Fed is in an impossible position. It is a national institution with global consequences. It is accountable to Congress, not to a world parliament. Yet the world has, by its own choices, wired itself into the dollar system so deeply that there is no easy exit. So what is the Federal Reserve really? It is not a conspiracy. It is not all-powerful. It is a committee of human beings sitting around long tables, peering at charts and models and market data, trying to set a short-term interest rate and a stance for asset purchases that will nudge a $25 trillion economy in the right direction without tipping it over. It is also a symbol of something bigger. The shift from a world where individual bankers like JP Morgan personally save markets to a world where central banks, with their ability to create and destroy reserves, act as the quiet kings of money. They do not own the railroads or the factories. They do not choose which app you download or which company becomes the next hit. They decide how easy it is for everyone else to borrow, invest, and spend. Their fingerprints are on your mortgage rate, your credit card interest, the yield on your saving accounts, the valuation multiples in the stock market. They are not the market, but they are the climate. And yet, for all of that, there is a strange counterpoint sitting 1,000 miles away from Washington in a quiet Midwestern city. No trading floor, no marble hall, just a modest office building in Omaha, Nebraska. Inside, an elderly man in a simple suit sips a cherry coke, reads annual reports, and makes decisions that have very little to do with the next Fed meeting and everything to do with the next few decades. While the central bank adjusts interest rates by fractions of a percent, this man buys entire companies and holds them for years. Railroads, insurance firms, manufacturers, Coca-Cola distributors, and furniture stores. He does not try to predict the next quarter's GDP number. He asks, will this business still be making money in 20 years? And is the price fair? He runs Berkshire Hathaway, a conglomerate that started as a failing textile mill and became one of the largest collections of operating companies and investments on earth. His name is Warren Buffett. Next time, we will leave the hushed boardrooms of the Fed and travel to Omaha to sit with the Oracle to understand how he built an empire by mostly ignoring the short-term noise that central banks, traders, and TV anchors obsess over. If the Federal Reserve and the dollar represent the weather of modern finance, Warren Buffett and Berkshire Hathaway will show us what it looks like to build a shelter sturdy enough to stand through any storm simply by being patient when everyone else is in a hurry.